Welcome back to another episode of Investing Explained. Here's today's question.
I really like the question, and the reason I like this is because you're talking specifically about the bottom line. You're talking about the net income of the company and the profit that it's producing. Whenever I hear somebody say the net income's, decreasing, it's going down, and the company's getting penalized in its stock price because that net income's going down, one of the very first things that I want to look at is the top line of the income statement to understand if this is something that's being generated because the company has lower sales, or because maybe the company's expenses are growing, or maybe a combination of both of those things might be causing the net income to go down. Because whenever you understand what's happening on the top line and then you work your way down the income statement, you have a much better idea and interpretation of what's going on at the business. So let's take an example. Let's say that we have company X, and you were saying that the net income was going down, but let's say that the revenue, the top line of the business, is also going down at about the same rate as the bottom line. When we would see this scenario play out, what that really is telling me is that the company's losing market share. This is telling me that the assets that the company owns are not as competitive as what they were in the past if that trend is continuing to go down on their top line. This is really, really important. So if you don't fully understand what's happening to those assets and why they're losing their market share to some competitors, that's a red flag. That's something you absolutely have to understand as an investor, because if that continues, if that trend continues, it might be a value pick all day long, but eventually it might turn into a bankrupt company, or you might lose a ton of money on the price that you were buying it because it continued to go down in value a lot more. So I would tell you got to understand what's going on with the top line. And just so everyone in the audience understands what I mean by that, whenever I say the top line, so if we're talking about a company called Coca-Cola, the top line would be you sell one can of Coke for $1, the top line is $1. Then after you talk about the cost for the metal to make the can, the cost of the sugar, the cost of all the employees, the cost of all those things, the facilities, all that kind of stuff, it's subtracted out of that $1 price, and at the bottom you're left with maybe 7 cents or 10 cents or whatever the margin is at Coke, and this is after taxes. That's how you can kind of understand what I'm talking about here from top line to bottom line. So I'm curious what Stig has to say on this one.
So I think that the key words here in your questions, that's valuation and declining earnings, because clearly as an investor, that's not what you want to see. But it's always a question about what kind of value are you getting for what you're paying for? So let me just give you an extreme example. I know it might sound a bit silly, but imagine that you have a stock and it makes $1 million per share the first year, and then you have declining earnings of $100,000 each year. Now, clearly this won't be good because you have declining earnings, but say you can buy that stock for $1. So yes, I know it's a silly example. Yes, that would be a great investment because you would get so much back. So that's the first thing that you need to look at. You're specifically talking about real estate company, but the process is really the same. You're basically just discounting the future cash flows, whether or not they're declining or not, and then you compare that to the price today. I think the main problem I have with companies that have declining earnings is that they're often harder to value. I'm not talking about the math here because the math is basically the same, but it's harder to estimate the cash flows in the future. If you do see a company with declining earnings, it might mean that they have lost competitive advantage. They're losing market share, as Preston also pointed out. So it's just harder for you to come up with a good estimate. And in valuations, you would like to have a better estimate as possible so you can ensure that you will buy it at a discount. I think that's my main concern about declining earnings. It's not in itself that it is declining. It's all compared to the price. That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.